Hey everyone, welcome back. We're working our way through RE Capital's amazing serial acquirers document that they put out just recently. I want to put my summary together in little bite-sized chunks so that we can sort of think about each one each week. That's how I'm best absorbing the information, just doing it little by little. And today the focus is on stability and reducing our risk in investing. So why serial acquirers are cool is a little bit because of the picture here on the screen of this tree with its root system. See, most people focus on the visible and the measurable. Like a growing tree, we look at like the actual tree, right? But why the tree is so strong and so important and so stable, and that it can produce fruit, is because of its root system, that the things that we don't see. So what is the foundation of the business? And Brett Kelly at Kelly Partners Group once told me that, he said, for many years, if you're building a skyscraper, you're building the foundations. You're going down first. You go down, you really make sure this thing is going to hold up, and then only the last part of the construction process is when you actually see the skyscraper sort of coming out of the ground and going up really tall, and you say, wow, look how tall this thing is. But what you don't see is the work that's gone in underneath to build this tall object. So a little bit the same analogy here. What we're trying to do with serial acquirers is also avoiding the blow up. So like most investors are fascinated with like the serial acquirers, and it stems from the returns, but I think we should focus on serial acquirers because of the stability, the diversification, and that this provides, that a group of companies can deploy this capital, large amounts of capital at higher returns. That's the attractive stuff, but they're doing it in a way that is so reliable with all their different little businesses that if one of those roots or one of those businesses has an issue, it's not going to affect the returns of the tree. REQ Capital summarized it pretty well by saying, so to reach the second half of the chessboard, where exponential growing factors gets going, one mustn't aim for just the highest reward, but they have to avoid the blow-ups at all costs. That's why having single exposure risk. Think something like Netflix, where they have essentially one thing that they're really good at, streaming services. And like a lot of companies could come into that space. All of a sudden, Netflix could have some sort of, scandal go on in that business, and things could get ugly really quickly. So I think the idea of not trying to find rockets, but trying to avoid meltdowns is a good investing philosophy. So the pictures on the screen are pretty blurry, and they're blurry because there's so many businesses going on here with both Lifco and Constellation Software. I think this is a great example of looking at that root system of the tree. This is the thing that brings Lifco the investment idea, or Constellation Software as the investment idea. That's what gives it all its power, is all these tiny little businesses that funnel the cash to the head office. And it's kind of like a tree. Now, the next topic is decentralization. And the idea is to give decision-making at the business unit level as much as possible. And why is that? Well, it's because this allows the head office, like Lifco or Constellation Software, to focus more on acquisitions. This next bit of information is from Johan Steen at Technion. He said this: one of the key things is that we do not control how our companies do business. We help and support them. Technion has board representation in all the subsidiaries where we try to push positive energy onto the CEO. If something out of the ordinary happens, someone from the Technion management can be landed in the company to help them sort things out. We encourage CEOs to become friends amongst themselves and exchange ideas and beers. We try to meet up a couple of times per year to build strong relationships, learn new things, and inspire each other to greatness. Now, this is more of a bit of a hybrid approach from Technion, where they've not letting the subsidiaries go completely and no reporting or anything like that. They still have to do reporting. They still help there if needed and support there if needed. But essentially, the business units run themselves as a separate business. And speaking of Technion, I follow it each week in an email that I put out called Yes Stocks, No Stocks. There's a link in the description for that if you're interested. I follow a lot of other serial acquirers as well. Okay, now the next thing I'm going to read is from Larry Medelson, who's the HEICO CEO. Now, this is quite a long passage here, but I think it's really important. So bear with me. Let's go through it sort of section by section. So the first thing HEICO does in an acquisition, and the most important thing, is they really scrutinize and analyze and get to know the person who is selling the company and how he manages it. If he treats the people well, this is going to be very important. So as an example, if they're walking through the factory floor with the CEO and he says, oh, this is our machine operator, this is this person, this is this machine, That's not very impressive. But if he stops at a particular person and says, "Oh, this is Charlie. Charlie, how's Anne going?" Anne being his wife. "How's your family? What, you've been here for 22 years now? You're part of the furniture now." Makes a bit of a joke. Anything like that, you can feel that there's rapport there. And for HEICO, this means an awful lot. They understand that the relationship between the owner and the company and his workforce and the team members, that's the stuff that's going to go a long way. And that's what HEICO are looking for in an acquisition. And acquiring businesses with those types of business owners means that you can be more decentralized. It means that you can have more trust in those businesses are going to do the right thing, and they're better businesses for the long term anyway. You've got to have happy employees, and that'll probably lead to happy customers, and that'll lead to happy investors in the serial acquirer. Now, this stuff isn't easy to find. Ulf Lilius, the CEO of Momentum Group, I think had this very valuable little part to say as well about decentralization. So he said that decentralized responsibility is easy to say, but a little bit harder to do. But for Momentum Group now, it is getting easier for them. He says it's like Jeopardy. You ask the question, but they have the answers. So that's how you lead. You lead by the questions, not lead by, well, if I were you, I would do it like this. That's not decentralization, that's centralization. So you've got to get the people who are working there, the CEOs of these small units, to solve their own problems, and you just ask the right questions. And at the end of the day, it's going to be their idea. So having good decentralization is going to come a lot down to culture and the people and those soft skills. And that's what the good serial acquirers have been able to do. All right. I hope you're enjoying this little summary series of REQ Capital's work. We're going to do another one next week. I'm trying to keep it in little bite-sized chunks so we can absorb the information and learn from it slowly rather than me just dumping all of this on you in one big video. I thought I'd break it down. So hope you're enjoying these. We'll keep going next week, and I'll see you then.